welcome to another episode of the 7 and 7 Show with Zack Ellison. Today I have with me Ken Hall, a partner at DeepWork Capital in Florida. Ken, thanks for joining.
Thanks, Zach. How's it going?
So tell everybody how you got here. Maybe we start with what you're doing at DeepWork now and then kind of your path to get to DeepWork.
Yeah, so I'm one of the partners at DeepWork Capital. Made partner last month. So now getting used to the title change. But joined DeepWork a little over 3 years ago. Maybe we could touch on that in a second. DeepWork's a early stage venture firm based in Orlando, Florida. We're founded in 2015. One of the first kind of angel networks turned into institutional investment firms in the state and in the Southeast. We're now investing out of our third fund. We also manage a handful of investment programs for the state. So we have both public and private funds that we manage and invest primarily into the state of Florida, but we invest in undercapitalized markets throughout the country. We invest in seed and Series A stages. We believe that you can build great companies from anywhere, not just in Silicon Valley and New York and Boston. So
that fits with my thesis as well. So are there any sectors that you focus on, or are you industry agnostic?
I would, out of those two options, I would say more industry agnostic. There's certainly industries that we stay away from, which I could rattle off. But I mean, to me, we invest in emerging technologies. So we invest, we're not afraid to invest in biotech and life sciences. If we're investing in enterprise software, it's usually, pretty tech forward, things like cybersecurity or fintech. But we invest in emerging technologies within the enterprise, typically enterprise software on that side of the house. And then we invest in life sciences and biotech as well.
So what are some of the things you don't invest in?
There's a handful of industries that we just have been burned on that we would typically stay away from. Areas of like HR tech, for example, things that we found that a lot of those businesses, just businesses that are in industries where they're not, they're providing wants and not necessarily needs or must-haves. So I would say that that's an underpinning of a lot of the areas that we've strayed away from.
Got it. So in addition to the sectors that you focus on, you said regionally you'll look at underserved areas. Are there any areas that you focus on? I mean, obviously Florida, because you're investing in the state of Florida's money, but is the Southeast a big region for you guys as well?
Yeah, I'd say about 80% of our capital is in Florida and its surrounding region. So, we've done deals in Texas, we've done deals in, Georgia, we've done deals in Tennessee and the Carolinas. But, I think there was a period where, especially kind of right after COVID, everybody was really happy doing diligence remotely and writing checks after a few Zoom meetings. And, it is obviously really nice to be able to do diligence and build comfort from afar. But at the end of the day, these are relationships and long-term relationships. And if we're putting our LP's money or stakeholders' money into early stage, high risk investments, you got to spend a lot of face time with those founders. It's great to be able to get in a car and not do a 5-hour flight to go see them. So we've gotten a lot more comfortable. Kind of the pendulum swung back. In other words, we've gone back a lot more to investing in companies in our backyard and being able to go see them in person and meet with them and make introductions, all in person, and being able to help them. So
It's interesting. I just wrote an article relatively recently for Venture Capital Journal, which is part of a monthly column I write on venture debt. And basically, I've been breaking down the key components of how venture lenders should analyze startups. And of course, we're looking at a different stage company than you guys are in later stage, but still many of the companies that do well for you will eventually be eligible for venture debt. But the piece I just wrote was on the importance of the leadership team and the founder. And there was a really interesting piece of research that was in the Harvard Business Review, written by a number of very good professors, including Stephen Kaplan, who's at University of Chicago, who's like the VC maestro. And what they found was when they basically interviewed close to 1,000 VCs. It was 900 and something VC firms on their process and how they invest. And 90, I think it was 94, 95% of VCs said they evaluate the founder when they decide what deals to do. And that was by far the most commonly cited factor. And number two is business model, which was 74% cited that. So to your point, it seems like having a great relationship with the founder and making sure that the founder and the leadership team are excellent is mission critical, especially earlier stage, because you're really betting on the people more so than anything they've done historically with the business.
Yeah, I'm increasingly convinced that that's almost the only thing that matters at the earliest stages. And I mean, the things I look for in founders are just one, being obsessed, and two is resiliency. It's, at the earliest stages, it's like, if I go to bed at night and we have, RLP's money in the company, do I believe that this founder, isn't going to rest easy unless they've exhausted, kind of every means to advance the business forward and to preserve our capital and to have it appreciate. And, it's like if door A doesn't work, I'm convinced that they're going to go through door B. And if door B doesn't work, they're going to go through door C. If door C doesn't work, they're going to build a door and then go through that. And like the resiliency and the kind of tenacity from some of the early stage founders is really what makes or breaks the companies at the earliest stages, because nothing's going to go according to plan. So you need somebody who's resilient enough to break through.
I think about it the same way. I envision a founder or a team that's got like a battering ram that you see with like LAPD, like SWAT, right? Just they're not taking no for an answer, right? Like they're coming in one way or another. And I
Yep.
think one of the things I wrote about in the article recently in Venture Capital Journal was how I don't like it when founders have a plan B. Like if you ask them, what if this doesn't work out? What are you going to
Yeah.
do? They're like, oh, I'm going to do, X, Y, and Z and go work for this firm, or I've got these other startups I want to do. To me, that's a quick no,
Hmm.
because to your point,
Yeah, it's like burn the bridges.
exactly. Yeah,
Yeah.
exactly. Burn the ships behind you, like
Yeah.
Cortez. I mean, that's
Yep.
literally the only way you're going to make it, in my view. And
Ex-
especially with the earlier stage folks, they're going to encounter so many difficulties. They're going to have to pivot. They're going to experience a lot of hardship along the way. Even the best run startups are going to
Yep.
have to pivot consistently. So I 100% agree with that. And while we're on the subject of what you look for in founders, what are the other things that you look for outside of um, obviously resilience, persistence, a sense of relentlessness, but what else do you look for when making investments? And maybe not just with the founders, but in general, what are like the key factors that you look at?
Um, yeah, I mean, just the other things, obviously, with founders, if you're just like experience, having actually solved, experience the customer's pain points, or being a second time, third time founder, like we have had more success betting on second, third time founders. Yeah, I think there's analysis done that if it's a second time founder who had some, mild success, not some astronomical, multi-billion dollar kind of outcome, they tend to be really motivated. And it's even things like, we've seen it with second time founders that we back, where it's just like even the efficiencies and like the board meetings and like reporting to investors, they know like when to lean on their investors to ask for help. You often see first time founders like not want to bring problems to light because they are afraid of how the investors are going to react. Experienced founders know those dynamics a lot better and know when to leverage their network and know when to ask for help. So, just that's kind of the other factor. Obviously those things can be overcome with a first time founder, but it's just a lot more common in second or third time entrepreneurs. I don't know, the other factors that we look for when we're investing in undercapitalized markets, it's like the scalability of the business model, to do it in a capital efficient way. Like I really like self-service software, product-led growth SaaS, where you don't incur kind of an incremental sales and marketing expense or a dev expense with an additional sale of the product. It's a self-service product. It can create, a lot of momentum without incurring a lot of expenses. We like, even in life sciences, which is a lot more capital intensive, being able to bring in non-dilutive capital so our dollar stretches further. So we look for these kind of efficiency gains in capital that we can leverage from undercapitalized markets. And then there's a lot of dynamics that maybe we could talk about later around the market and kind of demographics or trend lines underpinning a lot of the markets that we would look at.
Yeah, I like this idea of what I call footprint. So when you've got a second or third time founder, they've got a greater footprint for you to examine. And I distinguish footprint from track record because a lot of times when you say track record, people mean like a numerical based track record that you're porting from your last firm. Like when
Yep.
people ask me about A.R.I. and they're asking about my track record, what they really want to know is what were your percentage gains, right,
Yeah.
every year. But if you're a founder and you are, especially if you're a first time founder, you don't really have that track record to show to people. But you do have what I call the footprint, which is evidence of all the other things you've done in life that you've either succeeded at or failed at, but ostensibly learned from. So I
Yeah.
think that's really critical, is to figure out how do you find the signal through the noise, right? Because there's a lot of data to look at. It's not transparent, right? Especially when you're looking at people's backgrounds. What are some of the things that you look for to try to figure out if the founder is going to be everything they say they're going to be, and they're going to do what they say they're going to do?
Ooh. Um, I mean, that's the name of the game, right? That's one of the hardest things to actually figure out before you write them a check. I mean, that's one of the benefits of a weak market that we're in now is, you're able to spend a lot more time with the founders and de-risk that and maybe answer that question a little bit better, right?
Mhm.
So the more time we get to spend with them in person before making an investment, the better. Also, a lot of it comes down to just throughout a diligence process. Well, I'd say like prior to even meeting them, right? There's all these examples now. They're almost like clickbait articles where it's like, here's how I raised $100 million with my cold email. And it's like, okay, maybe that happened with like, I could probably count on two hands the number of company, maybe one hand, the number of companies that have actually done that successful, but that's just not real. And it's a if you're relying on that as a surefire way to fail, I mean, to me, it's a relationships business and it always will be. And if we are deploying millions of dollars of capital into a company, we really have to trust that founder. And one of the best ways to do that is through referrals in from other people that we already trust. And you're kind of hacking, months ahead because I have a warm intro, ideally from another CEO or founder that I already really trust that has executed that. So if
Mhm.
you're trying to break into a portfolio and you can get a referral in from somebody else in that portfolio, it's going to go a lot further for us from, evaluating the founder and their ability to execute. And then even throughout the diligence process, like that's one thing that we love to hear when we talk to customers from early stage founders. If we're talking to a customer and the customer is like, singing their praises and is like, this is a person I can call at 8 p.m. or whatever, and they're going to, go resolve any issue I have. We want to diligence that kind of prior to even meeting them. How were they brought into our network, and throughout, right before we're about to write them a check after months of diligence, after we've built that trust with the founder, we're still going to have to understand that from the lens of a customer, from a partner, from other employees in the company.
So to summarize, some of the things you look for, obviously a very strong founder or founding team, scalability of the business model, a lot of capital efficiency, like you mentioned before, um, the diligence, of course, which you're digging into on many fronts. How do you feel about humility? This is something I've been thinking a lot about recently because I'm finding there's two different types of founders that I'm meeting a lot of in this market. One are founders that are still a little bit, I don't know how to put this. they've got a little bit of ego from
Then
2021 and 22, and they still think that they're entitled to a lot, even if they haven't put up results yet. And then there's founders who maybe started a little bit later, or for whatever reason, didn't really benefit from that bubble by raising a bunch of money at the peak. And so they've been raising money in the last 2 years, which has been very, very difficult. And so they're a lot more humble. They realize that VCs and venture lenders and other investors have a lot of options. They don't need to chase the shiny object. I mean, obviously people have an AI and they're probably going to get burned. We'll see. We can talk about that later. But I'm just curious what you think about that in terms of like how you feel about the market influencing people and their ego, and also like if you want a big ego, if you want somebody who's got a lot of confidence but who's also coachable and humble in other ways, like how do you think about that?
yeah, I mean, there's a very fine line there. I mean, like the humility aspect, I think that ties back to, I mean, at the end of the day, like we can get caught up in all of these, um, I don't know, like interim metrics around, you know, the company's ability to raise capital or whatever. Ultimately, it comes down to like what shareholder value can you build and what is the exit value of your company when you go to exit it, right? And so I think of like the ways that that can bite you is what I was saying earlier with like not being transparent to the board, not leaning on your network, not admitting when you have issues, not asking for help when you need to ask help because you are too confident, you are too, arrogant in your own accomplishments. But then there's that balance and the benefit of when, you know, you are a little egotistical, you are a little confident because it does take you know, extreme confidence to think that you can displace a 1 billion-dollar company that's already servicing a customer that you're trying to win. And to convince an employee to take a 50% pay cut from Microsoft to come work for your team, you're not going to get there with being not confident. And so there is certainly a balance there, and ultimately it matters to what value you're building for the company and for shareholders.
So two more questions before we move on when it comes to evaluating opportunities. One is around valuation. How important is valuation to you?
Um, it depends. I mean, there's certainly some opportunities that when you're underwriting them, extremely sensitive to entry price because the exit potential is, very, I don't know, finite, measurable. Like, if you're looking at, for example, like a medical device, we're very sensitive to entry price because we can kind of bottom up size the market and, assume a certain share, and therefore the exit is going to be 400 million. So the only way to 10 exit is to get in below 40, for example. You know, there's other opportunities to where we might be a little more price insensitive because the outcome potential is a lot larger. And I think of those as almost like category defining businesses. If you were to try to, you know, underwrite some of those businesses just typically and say like we're super sensitive, we need to get in at this pre-money or that pre-money, you're going to miss out on potential upside because you're going to measure it and say it's going to look like this without factoring in what the other markets are going to open up, what the other businesses, they're going to expand the size of the TAM, they're going to move into adjacent markets or introduce these other businesses. And if you kind of overthink those kind of opportunities, then you're going to miss out entirely. So,
Makes sense.
but in general, I would say we are more sensitive to entry price than most. I mean, I think especially outside of a zero interest rate policy environment, you've seen the size of outcomes drastically fall down, right? Like the number of companies that were going public at over $10 billion was just absurd, 4 or 5 years ago, 3, 4, 5 years ago. And it's a lot easier to exit at multi-billion-dollar outcomes when companies are trading at 50 times revenue. And when companies are going back to long-term historical averages for how they trade, then the exit environment gets a lot tougher. And so therefore you need to be a lot more sensitive to where you're getting in at price. And so again, it all matters like exit entry price and exit price. And if the exit environment, I think you need to underwrite to what the long-term averages are from an exit standpoint. And I think that's one thing that kind of the post-COVID, post-ZERP like semi crash that we saw that taught a lot of investors at the early stages was like the people that were writing, oh, Snowflake's trading at 150 times revenue, so therefore this cloud-based startup might exit at 150 times revenue. Like that was absurd. You should be valuing them according to like long-term historical trends, not off of what a 30-day average move looks like.
Yeah, that's a great point because people will often use comparable analysis, or
Right.
comps, but you got to make sure you're choosing the right comps, right? You can't say, oh,
Yep.
like you had a couple of exits at 150 times revenue, so therefore all these other companies should be trading at 150 times revenue, which is to
Right.
your point, pretty ridiculous. So last question on this before we move on to the macro environment. Um, how do you measure traction with some of these early stage companies? Because obviously that's important. They can talk a good game, but how do they show you that they're living up to it?
Um, I guess I would maybe attack that in a couple different ways, which is, even pre-revenue, there are things like traction. And I think one of the, important, like maybe the takeaway is to like, I think founders should build in public a lot more than they do. And you see a lot of founders and a lot of startup companies that are kind of operating in stealth or not getting the product in the hands of customers or even soliciting feedback or not trying a marketing campaign. And it's, analysis paralysis. And there's examples of even like when Dropbox was launched, they launched a video 6 or 12 months before the product ever came out or was even ready just to see what people thought about it. And I think that if you launched a business like that, solicited feedback, then you could demonstrate traction without even having a product. But if you have a product in market, it's user signups, it's like the number of customer, like the amount of time they're spending on an app or in a product, even pre-revenue. Um, and then once the company is at a revenue generating stage, we're looking at obviously growth rates. We want to see triple digit kind of growth and seeing improving trends in SaaS metrics where we have, kind of permission to believe that the business can get to 100 million ARR kind of stage and doing so in a capital efficient way. So if, we see them spending, $10 for every $1 of ARR they're getting, it's not going to go very far.
Those are great points. I love the idea of getting a lot of feedback and then iterating a lot. And I agree with you on this idea of building in stealth is not the right way to do it. There's a couple founders now I've seen on LinkedIn that have hundreds of thousands of followers now because they're building in public and they're very open about what they're doing well, of course, but they're also very open about what they're not doing well. And I think that that transparency has really helped them quite a bit, and it winds up just generating so much more free or relatively cheap marketing, right? Like they're not paying for those eyeballs really. I mean, outside of their time and maybe a little bit of production costs, um, it's very, very low cost content. And that's the
Yep.
other thing I've seen a lot of too is just a shift towards really content um, driven founders in a sense where they're coming out with, to your point, ideas, and they're getting feedback and they're getting people interested before they even launch the product. And they're really building their own brand in a sense. And I think that's it's always been important, but I think one of the things I've been thinking a lot about actually is how with technology where it is now, with AI and a lot of the efficiency tools that we have, you can really scale infinitely faster and cheaper than ever before. And so what makes a company more scalable than others? I mean, obviously there's some obvious things like the size of the market and the competitive environment, but I think the big factor is how good is the founder and the leadership team to a lesser extent at generating organic viral content, right? Because it depends what sector you're in, of course, but I've just seen so many companies doing really well because they have a charismatic, dynamic founder, and they're able to get visibility that their peers can't get, at least not as
Yeah.
cheap.
Yeah, but even like, I don't want to like have founders think that they need to be, you know, Elon Musk or whatever, or he's probably not even the most charismatic. You know what I mean? You
Yeah,
don't need to be the most flamboyant and publicly available and visible CEO. Because even like one of my beliefs is like products can be viral. And if you have a product-led business and it's capital efficient, like one of the main components I look for in a product in itself is virality, where if you have Zoom users introduce Zoom to other Zoom users, right? The product sells itself. Same thing with
hmm
Dropbox, same thing with Calendly, same things with most of the best in class product-led SaaS businesses. The product itself is a component of virality. So it's not like there's a lot of ways to create virality from an individual standpoint, but you can also create virality from a product standpoint. And you've seen that with social networking businesses, right? I mean, it's not like Mark Zuckerberg early on was the most charismatic founder, but the product is there's network effects, there's virality in the business, and you can create $1 billion business, just by users introducing your product to other users.
100%. And I agree with you that, and that's more important than the founder being
Right.
a viral brand in a sense. But I think you can go both ways because there's some
Yes.
folks that
Yep.
are, very charismatic founders. They don't have the best product, but their marketing is so good that it doesn't even matter if there's better products because nobody's going to hear about them, at least not in the
Yep.
same way. But to your point, I think all else equal, I'd rather have a product that created virality. So
Yep.
I
Yeah,
completely agree with
yeah,
you.
that's certainly one of the things we look for within like the capital efficiency element, and like tying that back to, you know, kind of our thesis of investing into undercapitalized markets or places like Florida or outside of the tech hubs. It's like you don't know where those businesses come from, right? It doesn't matter if Calendly was built in San Francisco or New York or Georgia. That's where that business came out of, right? Like Zapier was founded out of Missouri. It's like there's a lot of great components, or great stories of these multi-billion-dollar enterprise SaaS businesses that have this virality built into them that are built from, markets outside of the major tech hubs.
I agree. So let's shift gears and we're going to talk about the bigger macro picture. So in terms of the current state of the markets, what are you thinking about right now in terms of, the last couple of years, how it's been in terms of fundraising for companies, but also, the amount of companies that have been successful, the few that have IPO'd, and then what you're thinking about now, and then where we might be headed over the next, year or a couple of years.
Where it's kind of hard to predict over the next year, a couple of years. Um,
So let's
pretty
let's talk about where we're at now.
volatile market environment for sure.
Mhm.
Look, I mean, I think venture as an asset class is struggling a bit because there's a lot of very price insensitive buyers that got into the market when it was very frothy, and there's a lot of companies that shouldn't have gone public that went public, and now there's a lot of companies that can't go public that should go public. And this, in a way, like maybe this is the kind of a broader theme of the conversation, but it's like almost the private markets are this like bigger theme of you know, building in private, right? Or building in stealth, where it's like the public markets used to be medicine and force companies to really mature and have all these controls and processes in place and really mature as a company. And you do have to shift to, quarterly reporting, and that sucks for kind of long-term business building. But I, there's this huge backlog of companies that just need to go public, in my opinion, and that will create liquidity that's really much needed for LPs, and then that will create a downflow of more activity at the earliest stages. Um, I mean, in my opinion, I think the venture market is a lot weaker than it even is signaling. Like year over year, I mean, it's pacing to be just about flat. From 23, which was obviously way down from 22, which was obviously way down from 21. So we're kind of at 10 consecutive quarters of flat kind of activity where it's it's more or less stabilized. But I think if you take out some of the outliers, like XAI, the Elon Musk company raised $6 billion, or CoreWeave raised billions of dollars, or you know Wiz raised billions of dollars. Like, you take out a few of these outliers and mega rounds, and the market looks extremely weak. I think, my analysis of Q2 was that it was the highest concentration of deal value in rounds over $1 billion in the history of venture. It's a lot of these deals that are, you, like, if we're going to talk about AI, it's like an arms race where there's billions of dollars flowing into a subset of maybe 10 companies. Anthropic and OpenAI and XAI have, I think, combined raised over $20 billion in the last 12 months. So you take that away and the venture market looks a lot different. And to me, it's companies need to go public, because it's really hard for some blockbuster M&A to go through. The DOJ and FTC are blocking a lot of acquisitions. Private equity buyers are hypersensitive to interest rates, so they're not really gobbling up a bunch of billion-dollar venture-backed companies either. They're doing a lot of take privates because the public markets have been beat up. And so the only real way to get liquid and for liquidity to start flowing back through the venture markets is some really highly qualified companies like Stripe or Wiz or CoreWeave going public, or Databricks, going public in the next 6 months, which I think would be a big catalyst for more activity in venture.
Yeah, it's tough. It makes me think that there's probably going to need to be a shift in the entire model, right? Because the model that worked previously has not been working the last couple of years. And to your point, we've got this giant backlog of companies that would be great to IPO, but the fact is they probably aren't going to anytime soon because the IPO market's still shut. And that's when the general broader stock market and risk markets have been performing, better than ever, right? So if we head into,
Yeah,
a
but I don't know if
recession.
I would disagree with that. I mean, I think the broader risk markets have been performing very poorly. I think it's just been really influenced by seven companies. Like, I think if you exclude the Magnificent Seven, I think the Magnificent Seven have accounted for 62% of the S&P 500 gains in the last year, something like that. I don't know. I was reading an article yesterday on it. Whatever it was exactly, it's believable. I mean, the fact is, I think that, like, there's a broader tech and SaaS and risk asset recession that has been obfuscated by the performance of 10 to 20 companies.
I 100% agree with you. I'm actually glad that you brought that up, and the way you framed it is perfect, because this is what I've been saying for the last couple of years, because you see these public market investors and they think things are going great, right? They're like, oh, the stocks are killing it. I just put money into meme stocks, or the Magnificent Seven, or I buy crypto and it just goes up, or I buy houses and they just double in value. And the reality is that's all on the surface, but the underlying machinery of the markets is completely screwed, right? Like, IPO market volume is down over 95%, right?
Mhm.
95%. Like, you're literally getting almost no IPOs getting through the hoop, right?
Mhm.
And you've got like a lot of people that I would call like speculators that are driving the public markets, but the reality is much bigger than the public markets are the private markets. Like, people forget this. They think like stocks, like the S&P 500
Yeah,
is an
yeah.
indication of global performance in a sense. And it's really not. Like, the public markets are like the tip of the iceberg. And the reality is the tip has looked good the last couple of years, but underneath that is a complete disaster. Like, people that are in VC know how bad it is. People that are in other, certain risk markets know how tough it's been. And so I guess for the point I'm getting at is I think there's gonna need to be a new model, because this model of throwing money at early stage companies and then hoping that one day they'll learn how to run a business that actually generates, profitability, like, that model doesn't work, right? It only works when people are super euphoric, and euphoria doesn't really last for that long. Like, we've seen this. There's always peaks. That you had the tech bubble leading up to 2000, then you had, a little bit more before the financial crisis. '07 was great for everybody, and then you had, basically 15 years of great times, and now we're maybe headed towards another downturn. But I don't know. I don't know what the answer is exactly, but I think there's going to need to be something that changes in terms of how early stage funding happens or how these companies exit, because they're not going to like exit into an IPO where they're trading at 150 times revenue anymore. I just don't think that's sustainable.
Yeah, I mean, to me, I think it goes back to what I was saying. It's like it matters your entry price and your exit price, and that's really all that matters. And
Hmm.
I mean, I still think betting long term in innovation and technology is a good thing to do, and it is a time proven, time tested way to make money, right? So I'm not like disparaging the asset class. I think that the challenges are that we need to find other ways for liquidity, which may come from secondaries, it may come from different relationships with private equity and growth stage investors, and them playing an outsized role in venture because they do have more dry powder, right? But there's also well-funded corporations sitting on hundreds of billions of dollars of cash that should be more acquisitive moving forward. Um, but I don't know. I think that if you get into innovative early stage companies at the right price and they wind up generating tens or hundreds of millions of dollars of revenue, there's going to be an exit environment for them, regardless of, you know, regardless of these trends that we're talking about right now. And so I don't know. I think if you invest at the right price, they build the right business in a space that's innovative, you're going to find ways to make money doing so.